What is debit and credit? Do not confuse debit and credit with the way it's used in normal English. You have to understand the way it's used specifically in accounting. Debit and credit are terminologies used to correspond to increase or decrease in an account. Such as we've learned in chapters 1 and 2, we learned about increase and decrease in accounts. Now we're learning the proper accounting terminology to discuss that increase or decrease. So debit means the left side, credit means right side. Remember when we talked about the accounting equation and we saw how assets was on the left and liabilities and equity was on the right? So that's really what it is. It's just taking your accounting equation and giving it accounting terminology. A debit can represent an increase or a decrease. Likewise, a credit can represent an increase or a decrease. So just because you say debit or credit doesn't mean you're increasing or decreasing. It depends on what account it is. Debits increase asset accounts and decrease liability and stockholder equity accounts. Credits, on the other hand, increase liability and stockholders' equity accounts and decrease asset accounts. In every transaction, assets must equal liabilities for stockholders' equity. This is the fundamental of accounting, the accounting equation. The total dollar value of all debits must always equal the dollar value of all credits. I would like to demonstrate an easy way to remember debit and credits. Remember your accounting equation, assets equals liabilities plus equity? Well, once you draw that equation, all you have to do is just put plus minus for assets, minus plus for liabilities, and the same thing for equity. Debit, credit, debit, credit, debit, credit. So we know now we can see that assets are increased by debits and decreased by credit. We can see liabilities are decreased by debit and increased by credits. We can see equities are decreased by debit and increased by credit. Now, remember expense and dividends that are close to the retained earnings, which is an equity account? Well, those decrease equity. However, if we're decreasing equity, we have to do a debit. So expense and dividends, to increase them, you have to debit it, because as these accounts go up, so does your equity account. They have a reverse relationship. So you have to take that into account. So once you drop this, just put expense and dividends on the debit side. You can kind of use that every time before you do that, because the more you do it, it'll start. You don't need to draw the chart, but it's kind of an easy way for you to just kind of start and have that to the side while you're working on your assignments. So we've learned that accounting is a language. So and we've learned about the debit and credit terminology. Rather than just saying increase and decrease, we have to make it complicated and say debit and credit. Well, if you're in accounting, you have to understand when you're an accountant or the accounting department says debit or transaction, you need to understand what that terminology is, because that's what is used in the commonplace in business, in accounting departments, especially for larger businesses. So we do need to understand the terminology, even though it's easy to go back to chapter 1 and do increase and decrease and do the accounting equation. Well, in the business environment, it's a little bit more complicated than that. That's one way to do it. This is another way to do it. But just because this is what is mainstream, you still do have to learn it. So now let's look at another terminology called the natural balance. A natural balance is basically what you have to do to an account to make it increase. For example, if an asset account, what do I have to do to make it increase? I have to debit it. So the natural balance of the asset account is a debit. The best way to learn debits and credits is by memorizing the natural balances of the elements, so assets, liabilities, and equity, like I showed in the previous slide. Once you know what the natural balance of the elements are, then you can determine debit and credits for sub-accounts. For example, I know cash is an asset account, so I don't have to think, is cash increased? Once I know assets are increased, I just need to know that cash is an asset, to increase an asset, I need to debit it. So here's a summary. So once you know the natural balance, that's whether or not you debit or credit to increase an account, You can decrease the account by using an opposite term. For instance, to increase an asset, you know you have to debit it. Well, if I want to decrease it, I just do the opposite, which is to credit. Let's take a look at a couple of examples. Uncle Joe pays $10 cash in exchange for a cup of lemonade. Well, let's see, what do? I know what happened in this transaction. Okay. Cash was exchanged for a cup of lemonade. If I'm selling a cup of lemonade, what is that? I'm getting revenue. Okay, so once I identify the account, which is the first step, then I have to figure out, okay, what kind of accounts are they? Okay, my cash is an asset account. My revenue is an equity account. Okay, so once I do that, what do I do next? Well, both of them increased. So how do I do that? Well, I know assets are increased when I debit it, and credit and revenues are increased when I credit. So I debit my cash and I credit my revenue for the $10. If I'm not sure, I can just have a little thing here that I, just whatever, a little note on the side because obviously when you're starting out, you're not going to know that offhand. So you look at that, you have a table of natural balances. I say, okay, assets, debit increases it. So I see increase, debit, and then I look at revenue, credit, increase. So that's how I know to debit my cash and credit my revenue. Okay, let's look at another example. Uncle Joe prepays $10 cash in exchange for a cup of lemonade. Well, when we're prepaying, it means he hasn't gotten the lemonade yet. So it's an unearned revenue. So I got my cash, which is an asset, and I got my unearned revenue, which is a liability. So I go up here, I look for cash as an asset, debit to increase. My unearned revenue, what do I have to do? It's a liability account, credit to increase. So I debit my cash, $10, and I credit my unearned revenue for $10. Now the third example, Uncle Joe buys a cup of lemonade on account. Each cup is sold for $10. Well, he bought the lemonade on account, which is accounts receivable. So accounts receivable is an asset account, and my revenue is an equity account. To increase my asset, I debit it, and to increase my revenue, which is an equity, I credit.